Hello everyone, my name is James Hughes, Chief Market Analyst here at Scope Markets. Thanks for joining up to our webinar today, and of course, after such enormous amounts of movement within the market, such an enormous move and shift in what we look at as traders over the last few weeks or so. This webinar is important. Now, today's webinar is not going to be as long as some of the other ones that we've done. It's not going to be it's not going to talk about anything which is necessarily away from the topic that that was advertised, of course, because what we're looking at here is how we protect ourselves. How we protect ourselves as traders. So that's one of the key things. Now, guys, just want to let you know, you can ask us any questions that what you'd like to do. Send questions through on the Q&A panel, and I will get to them, and I can answer any questions that you do have if you send through there. But I'm going to talk about exactly why the markets have been reacting like this. And I don't mean talking about the coronavirus or exactly what's happened there. But we know the coronavirus is a byproduct of what's been going on over recent months. So we'll talk about kind of how these markets have reacted. But some people may have suffered losses on their account. Some people may have found it hard to place any trades, and really that's what we're going to look at, and we're going to show you sort of why that's happened and why those the markets have reacted that way, and why maybe you've lost money on some of your trading accounts. So we will look at those. So bear with me 1 second. I'm just trying to get through one of these. Okay, right. So what I want to show you at the moment, I want to cover off a couple of reasons why these markets have gone like this. So the first reason we'll get to that and really see why this has happened is by looking at this chart here. Now, this is the oil price, and you should all be looking at my MT4 platform. Now, this is the oil price. This has been one of the key reasons why markets have moved in the way they have done over the last few weeks or so. Now, we know coronavirus is a big deal. We know that's why the markets have been moving. And of course, it isn't necessarily the health aspects which are the issue here. What's the issue? What's causing the moves is the fact that we're looking at a situation which is unprecedented, because what we're going to see is an economic impact. And that's what markets are reacting to, the economic impact of what the coronavirus means. So what the lack of air travel, what the lack of consumption in oil markets, what the panic buying may be, and what the lack of public gatherings and the government crackdowns on various different things to curb these moves. That's the key thing, which is the reason we're really driving and looking at all of these things. So oil prices, as I said just then, the oil price is key. And the oil price has been a reason why we've seen, and this chart really shows two things. It shows, number one, one of the big reasons why the markets have been so affected. And I've heard a lot of people say, and I've looked at a lot of questions of what people are asking. And people have been asking about, well, I was trading on something that isn't necessarily affected by the coronavirus. So I was looking at a currency that isn't affected by the coronavirus, or I was looking at a currency pair which was meant to be a safe haven, or I was trading gold which was meant to be a safe haven, but I still lost money on my trades. My account still went into very much negative territory. Why is that? Well, firstly, it's because of the oil price. So oil is fundamentally something which dominates our world. It dominates what we do and how our world as we know it works. And of course, that's a fundamental part of it. But what we want to see is why that affects our our trading in a way. So that's the key thing. Now, oil prices are dominated by the OPEC members, and we know OPEC members are well, the OPEC, the overall OPEC cartel dominates how much oil production there is. Now, what the outbreak of coronavirus has meant is that there's lack of demand for oil. So the amount of oil which has already been pumped isn't being used because people aren't going out, people aren't taking flights, people aren't doing a lot of things they would normally do. Now, that leads to big movements. And when there's too much demand, of course, and there isn't enough oil, markets will go up, prices will go up. When there's too much oil left over, prices will go down. And that's what we've seen here. You can only see this from the start of January until now. We've lost over 50% of the value of oil. Now, this is a fundamental area about why we tend to lose our money. And it works over a weekend. So let me just zoom this in and show you something. Okay. Now, you can see that the 9th of March here, the 9th of March was a Monday. 9th of March is Monday. Now, that means from Friday to Monday, the markets will close. The markets will close on a Friday evening, and they will reopen again on a Monday, on sometimes a Sunday evening, but most usually a Monday morning. So what happens, you often hear people talk about the risk and how markets have moved risk-wise from one side to the other. So why people have traded over weekends. A lot of times you'll hear that on Fridays, there's a lot of selling pressure because people are pairing off positions. Now, what pairing positions means is that they're closing out their portfolios, they're taking down their trades because a lot of people don't like to take trades over the weekend. Now, why is that? The reason for that is because, especially within currency markets, it's the only time, there's two main reasons. Number one, it's the only time that you will have markets close for an extended period. Even if it's stock markets, you see markets closed overnight. Yes, they'll close from a closing stock market time to reopen on another time. But the way markets and CFD trading works these days is that the majority of instruments, even including the FTSE 100, the Dow Jones, the S&P 500, they trade 24 hours a day. Okay. Now, the only time they don't trade is over the weekend, and they close Friday and they reopen Monday. Now, or Sunday night. That is a big risk period. And that's why on Fridays you often see selling pressure, because people are closing positions before the weekend because they don't want to take trades over the weekend. Now, why do they do that? Well, because there's more risk over the weekend. And that comes mainly when we're looking at a fundamental news story, which is driving markets. So the last time this happens often, but the last time this happened was the US-China trade war. Whenever there are discussions between Donald Trump and Xi Jinping, there was a summit over the weekend, we would see a lot of movement with people saying, I don't want to take positions over the weekend. Again, that's an understandable part of the market, and that's an understandable thing. Now, the reason that happens is because over the weekend, there can be huge movements. Now, not movements in markets, but changes in underlying news stories, which lead to something that we would explain as market gaps. So what a market gap is this. You can see this here from the down candle here to the bottom candle here. This is the close on Friday at this low point at $41.79. The opening point is then down here, $30.26. That's the opening price. So over the weekend, news flow had come out about the oil price, which meant that markets, if you look at all these other candles, you usually see the opening price and the closing price of the next candle are identical. So if one opens, the next one closes at the same price. Close, open at the next price. Close, open at the next price. Close, open at the next price. This resulted in a massive gap in the markets. Now, let me just, hold on 1 second. Okay. Now, what that gap causes is, remember, this happens over the weekend. So the 9th of March is a Monday. This is the period before, so this is the 6th of March. That gap happens over the weekend, and it happens because news stories come out over the weekend which cause huge risk moves. Now, if you have a position and you take that position from Friday evening at market close and you take it into Monday, you are taking into consideration 2 days worth of risk. Now, every day is of course risky on the markets, but these 2 days, the Saturday and Sunday, are even more risky because you do not have the chance to trade. So if something comes out which will affect the markets, you cannot close your position. Because for the simple fact that markets are not open. That's the simple fact behind it. Markets are not open. Again, and that's why people don't like to hold a position from Friday into Monday, because markets are closed. They cannot close their position. So if you were in the market, and let's take an example. Let's make an example. Say you've seen these big moves down here, and you've seen this big upside, and you thought markets have come down. I think they'll recover. So I enter the market, and maybe I enter the market at this area, $43.63. You could say, okay, I'm going to enter the market $43.63 on Friday. And let's just do this. Let's tick this along. Let's tick this along. Okay, and we look down here at this level, $43.63. We can see where the market was. We can see what happened in the market. But you can see the situation there. You can see it a bit clearer now. 43.63. Now, by the closing time on this day, the market had gone from $43.63 to $41.79. You're long. You think the market's going up. You think this brief fall down is a brief blip, and you think the market's going to go higher. So you're long. Okay, you've got wrong, but you're still in your position. Now at $41.79, that's our low point. Now the markets, you're closed on our Friday evening, and then they will not reopen again until Monday. So you don't have the time over the weekend to make a difference. Now, what can you then do? What is the option for you then to do from the other side? Well, you have no options over the weekend. But what you can say to yourself is, I have stops and limits. I will protect myself with risk management tools. So the stop loss to stop your losses, or the limit order to limit your profits. The issue with a stop loss over this time, and I will come back to this point in a moment, but the issue with this point over a weekend is that stop losses are not guaranteed. Stop losses are not guaranteed. And I will come back to that. Please just remember that point. Stop losses are not guaranteed. Now, what happens? I'm $41.79. I entered at $43.63. I want the market to go higher. I'm long of the market. $41.79 is where I am. I hope that on Monday, when the market opens, nothing's going to happen over the weekend, and I'm going to be in a good position, and this is going to go higher over the next couple of days. Now, once the markets close on Friday, there is then a headline on Sunday. Saudi Arabia are unwilling to cut oil production, meaning that despite the amount of demand and the demand is falling on oil, so despite the market moving and then there being demand and the demand for oil falling, Saudi Arabia are unwilling to cut production. So they're going to continue pumping the same amount of oil despite not so many people wanting to use the oil. That means prices are going to fall. Now, prices are not going to fall instantly because it's Saturday and markets are closed. So the market has time to digest this news. It will look into this news, it will digest this news, then the situation happens as to when we get to Monday, the market has to reevaluate itself. Something has happened which fundamentally changes the oil price, but the oil price has not been able to react. So what happens? The market reacts on Monday at the open. We tick. That's what happens. We go from here and we gap. The market gaps lower. It goes from $41.79 to $30.26. $41.79, which of course is massive. $41.79 is a massive side, and we end up opening at $30.26. That's an $11.5 move, which is a massive amount, Now, the markets have gapped lower. So straight away, we're long from here, we are losing, and we are potentially, our money in our account has gone, and we've lost out on our trade. Now, someone asked me the question a moment ago, is it possible to place a stop loss on a trade when the market is closed, or make changes to it? You can make changes to it. Sometimes you can place stops on some markets you can't. However, these stop losses, as I said, are not guaranteed. What that means is that a broker can't fill your trade. So a broker like Scope Markets, we cannot fill your trade. So if you have a stop, let's put our stop in. You can say, okay, I entered the market at 43.63. It closed at 41.79, but I'm happy because and let's make this easier. If we say, okay, I'm fine with this because at $40, I have a stop loss. My stop loss is at $40. Now let's change that color so we can have a little bit more visibility on what this is. Okay, that's our stop loss at $40. Let me change this. 1 second, just to make it, oh no, it's fine. Okay, so $40 is our stop loss. So you can say, okay, I entered at $43.63. I entered $43.63. The market has fallen down to $41.79. So it's off $1.84. So the market has fallen $1.84. Okay, now whatever our position is, we've lost money. But you say, I'm happy because even though it's the weekend, I have a stop loss at 40, which means the maximum I can lose, or in your brain, is $43 to 63 to $40, which of course is $3.63. That's in market movement, $3.63. Now, as a broker, we can only fill your trade. So this trade at $40 can only be executed if the market trades at this point. The market did not trade there. From $41.79, the next traded price is $30.23, not $40. It does not trade at $40. It jumps directly from here down to here. So your trade, your stop loss to close your position, it is filled, but it is not filled at $40. It is filled at the next traded price. And in this situation, the next traded price from $40 is $30.26, which means that instead of being filled at $40, you're filled $9.74 lower, because this is a market gap. This is a market gap. So it doesn't matter that you're able to place a stop loss over the weekend, but because the market gapped, this is the situation that happens. Because we can only fill your trades on official prices where the market trades. And the market does not trade at this point. It trades from here and then gaps to here. And as you can see, in this situation, the market has still not traded at $40. It came back up. It traded up to this level, $36.62. It still hasn't traded at 40. So this gap in the market is a big, big issue. And this is why people don't like to hold a trade over the weekend. It's why it's one of the riskiest things to happen. Now, this does not just happen over the weekend. This happens when markets have definitive open and close prices. So it can happen on the weekend over all currency pairs, over all indices, over every market. Over the weekend, this can happen. This risk is limited if you don't then trade over the weekend. So you don't hold your position from a Friday night over Saturday, over Sunday, and into Monday. Now, it can happen on indices. But one thing that scope markets will do to protect you in this situation, you can see here. Let me just zoom this in. You can see there is another gap here. Similar situation. Now, this happens when markets are particularly volatile. So someone's asked me a question here, do you profit if market gaps, maybe for this instance, you went bearish? Yes. So if you sold, so let's just take us back to that oil situation. If you sold here, if this trade at $43.63 is a sell, you don't have your stop loss here. You don't have your $40 stop loss. You profit from this move, of course, because this is going in your way. This is going in your direction. We can only trade you at traded prices. And sometimes we get, when markets are particularly volatile, you get spikes in charts. Now, one thing you must remember about the charts is that a chart is an indicative price only. A chart is an indicative price only. It does not show you every single tick. Sometimes the individual ticks of a chart may not be totally accurate, which is when we look for something called tick data. So when you speak to your account manager, or you speak to someone at Scope Markets and you have an issue with some of these trades, that's when we will then check the official tick data. Now, these are official prices, okay? We can only fill your trades at official prices. If trades do not trade at official prices, then we can't do it. And that's just a legal ramification because, of course, we cannot fill you at a trade that hasn't legally traded. So in this situation with our stop loss at 40, the market did not trade at 40. So we cannot fill a trade at 40. It's okay if you're short because you want the trade to go from $43.63 to $30.26. That's fine. That's not a problem because you're making money and it's gone further than 40. You've made an extra $9.74. So that's the situation that we have in this from this point of view. Now let's just take that back to the S&P. S&P has a similar situation where the market gaps. But because we trade the futures prices outside of market hours, then the situation will show that, yes, there can be gaps because this is an exceptional circumstances. Markets are reacting in an incredibly volatile way, in a way that we haven't seen happen for 10 years, for more than 10 years. Since the financial crisis of 2008, we haven't seen markets move in this similar situation. So that's the situation that we have. Okay, so if we look at this, look at how the markets move in the S&P, very similar situation. And where we are at the moment shows there are massive sell-offs continuing still today. We are likely to see this continue for a very much an extended period of time. So that's what we have. That's how markets are reacting. They are incredibly, incredibly volatile. And this volatility is difficult. Now, there are other ways we can protect ourselves. Market gaps are not the only way, but markets will gap in this situation. There's nothing we can do about them because markets as I've explained to you before, when we've been at various seminars, when I was in Nairobi at the latest seminar, whoever came to my webinar yesterday, exactly the same thing. If one thing we all have in common is we don't know where the markets are going to go. Yesterday, we saw the Bank of England cut interest rates, emergency interest rate cut. Exactly the same thing happened a week before with the Federal Reserve. We don't know these things are going to happen, so we don't know the markets are going to move this way. Nobody knew that OPEC were going to move as they did over the weekend. So we did not know that there was going to be a gap in the market. Of course, as a broker, how can we know this? There is, as I say, there is one thing we all have in common, and that is that we don't know when or how the market is going to move. Yes, we can make our guesses, but in this situation, in a situation where the coronavirus is causing such a massive issue for us, there is not much we can do about this. We can't make any changes to this. We cannot predict that this situation is going to happen. There are other things, of course, that you can do. Now, of course, they involve not using all of your position, taking potentially smaller positions when you trade. So in your trades, and when you look at your exposure, when in your trades, when you look at your exposure, not taking too much. If you have an account with, say, $2,500 or $1,000 in your account, if you take up all of your balance, you cannot give the market room to breathe. You cannot give the market room to make sure that you have enough space and equity in your account for markets to move against you. Because as I've said to you before, markets will never just move in one straight line. They will never just go higher. They will never just go lower. They will move, come up, go down, come up, go down. That's the situation. That is how markets will move. And we can just look at this. Even in a situation where markets are potentially very stuck in one direction, as you can see here, this is a very aggressive downtrend, but markets went down, they went up, they went down, they went up, they went down, they went up, they went down, they came up. This is always going to be the case. So there's very little that we can do about that. However, we just have to protect ourselves. Not taking on positions which are too big, and being aware that using stops, limit orders, are of course very positive things. They are of course very positive things, and they will work the majority of the time. However, when the market gaps, there's two key things we must remember. We can only fill your trades when markets trade at those prices on stop losses. On a stop loss, we will only fill that trade at the traded price. Limit orders are different, stop losses are not. Stop losses can only be filled when at the next traded price. That is one of the key things, and markets will gap. But stop losses the rest of the time during market hours are fine. And remember, you must not use too much of your account. Do not over leverage yourself. That is one of the most important things about trading. You must give the market room to breathe. You must give your positions the ability to go slightly against you before they go with you, because that will always be the case. Are there any more questions before I finish on what we've been talking about today? I told you this would be a slightly shorter webinar than normal. And at Scope Markets, we continuously want to help you, and we want to educate you about these things. This is why we find this so important to tell you about this at the moment and tell you about this today, because markets are very volatile, and we want to make sure that you as our clients are protected and have all of the information with you. So we want to protect you against these big market movements, which is why we scheduled this webinar so quickly, because we want this to happen. I can see a gap has just happened again here. You can see this gap here. This market has just gapped again. You can see here. The market has just opened in the US. It's 4:30 in Nairobi. It's 1:30 in the UK. It's 8:30 in the US. This is where the markets are moving. This is what the open we've just seen, and it's aggressive downside again. Now, someone asked me a question here. Can you point out how maybe we can place some indicators to indicate market reversal? Well, in this situation, it's very hard to see market reversal. However, I have something on here at the moment. If we look at this, we have a market channel. We have a market channel. And you can see that on the upside, between the blue lines, upside, downside. Okay? The market is bouncing between these two. Now, at the moment, you can see that this low point is only gone down to this point on this channel to the downside. It's retouched this line. So this is another maybe indication that we could see this turn around. However, the markets have only just opened. We must give this market room to breathe. It is a very dangerous time in these markets at the moment because everyone, not just markets, is in panic mode. So, and when panic takes over the market, it's very, very hard to make any decisions. So indicators about things turning around are very difficult, but at the moment, it's even more difficult. So it's a tough thing to be able to do. There's another question coming through. How do you draw a Fibonacci? I can show you how to draw a Fibonacci. So we'll take this from this example right here. On the MT4, there is a line here. Draw Fibonacci retracement. You can see this up at this higher point. You draw this from the higher point. Oh, I'll press the wrong button. Delete this. You click on this, you put it at the high point, you drag it to the low point. This then gives you your Fibonacci retracement levels. And remember, I spoke to you before, those of you who had been here before, been to my seminar before, which I'll be doing another seminar, of course, soon, in the next few months in Nairobi. But if you can see here that the most important ones are 61.8. That's the most important. 61.8, 50, 38.2, 23.6. But 61.8 is the most important Fibonacci retracement number. That's the key one. Are there any other questions before I finish up? Guys, as I was saying to you, here at Scope Markets, we are really desperately trying to help you out with this trading. It's an incredibly tough time to trade at the moment because of how markets are panicking. The panic in the markets is enormous. So this is something which continues to be an issue for us. But we want to educate you. We want to make sure we are here to help. So please feel free to send any emails that you do have to us. We have a live seminar explaining very similar things as I've explained today. A live seminar tomorrow in our office. If you'd like to sign up to that, please speak to our team and they will be able to sign you up to come to our office tomorrow and have this kind of seminar face-to-face to talk about the risks in these markets. Okay, so please feel free to do so. So please feel free to sign up to that. Apart from that, guys, thank you very much for your time today. It was good for you to join us, and hopefully please keep an eye out because we will be doing a lot more webinars to try and help you tackle through this very, very tough time. Apart from that, thank you very much, and I will speak to you again.